Welcome to this video on business and entrepreneurship education. Today we will look at Unit 6, which is on managing funds and cash flow. By the end of this lesson, you should be able to define and recognize the importance of cash flow, identify and calculate cash inflows and cash outflows, calculate net cash flow, and design a cash flow format. Cash flow refers to the movement of cash within an enterprise. It consists of cash inflows and cash outflows. Cash in the form of notes and coins is the most liquid form of money. Cash can be used for business transactions, which involves cash receipts or cash inflows, that is when customers pay the business, and cash payments or cash outflows, for example, when the business pays its supplier to obtain raw material. The cash flow cycle shows the use of cash in production until it comes back to the enterprise from sales of commodities. For example, a shoe manufacturer needs cash so that production can take place. It will need to buy raw material, pay wages, electricity, or rent. After producing the shoes, the business will sell them, where they will obtain cash, which will be used over again to pay for raw materials and other expenses. The business will obtain cash by selling its products. This is a continuous cycle known as the cash flow cycle. Enterprises must plan, record, and manage their cash flow carefully to ensure their liquidity. So what is liquidity? Liquidity is the availability of cash in an enterprise to pay for its transactions. The business must make sure it has enough cash to be able to make its day-to-day payments, like paying electricity bills, wages, or raw materials. If an enterprise lacks cash, it will face liquidity problems. It may be unable to pay its employees, its bills, or its raw materials. It may need to borrow money to make these payments. As it will have debts, its financial risk may increase as it may have difficulty to repay back its debts. An excess cash cannot remain unused. It means the business is not using its cash efficiently. It can be reinvested into the enterprise for its future growth. For example, the business may have additional raw material, additional employees, or additional machines, where it can increase its production and sales to have more profit. To manage cash flow well, entrepreneurs must have accurate information of cash inflows and cash outflows over a specific period of time. For instance, a cash flow forecast may be prepared. Cash inflow is the sum of money coming into an enterprise over a given period of time. Examples of cash inflows are cash sales, loan received, government assistance, money from sales of idle assets. Now we will look at how to calculate cash inflows. For example, we have for the month of March, we have as cash balance 15,000 rupees, cash sales 45,000 rupees, loan received from bank 60,000 rupees, government assistance 30,000 rupees, and sale of idle assets 20,000 rupees. We put it in this tabular form, so the cash balance at start will be 15,000 rupees plus cash sales 45,000 rupees plus loan received from bank 60,000 rupees plus government assistance 30,000 rupees plus sale of idle assets 20,000 rupees to obtain a total cash inflow of 170,000 rupees. Cash outflow is the sum of money going out of an enterprise over a period of time. Cash outflows are also known as cash payments by an enterprise. Payments, expenses can be incurred on a daily basis, weekly, monthly, or yearly basis. Examples of cash outflows are purchases of raw material, purchase of equipment, payment of utility bills, payment of wages and salaries, repayment of loans. Now we will look at how to calculate cash outflows. For example, in the month of March, we have purchases of raw materials, 25,000 rupees, repayment of loans, 40,000 rupees, wages and salaries, 20,000 rupees, utility bills, 5,000 rupees, and purchase of equipment, 40,000 rupees. We put it in this tabular form. So for purchases of raw material, it will be 25,000 rupees plus repayment of loan 40,000 rupees plus wages and salaries 20,000 rupees plus utility bills 5,000 rupees plus purchase of equipment 40,000 rupees, which will give us a total cash outflow of 130,000 rupees. An entrepreneur needs to calculate the cash flow balance at the end of a specific period of time. Total cash inflows minus total cash outflows will give us the net cash flow. A zero cash balance is where total cash inflow is equal to total cash outflow. For example, if we have a total cash inflow of 20,000 rupees minus a total cash outflow of 20,000 rupees, the result will be zero. Therefore, the net cash flow is zero. A positive net cash flow is a favorable situation. For example, if we have a total cash inflow of 35,000 rupees minus a total cash outflow of 20,000 rupees, we will have a net cash flow of 15,000 rupees. A negative net cash flow means a business is facing liquidity problems. For example, if a business has a total cash inflow of 18,000 rupees minus a total cash outflow of 20,000 rupees, we will have a net cash flow which is negative, which is minus 2,000 rupees. A cash flow forecast is an estimate of future monthly cash inflows and cash outflows over a given period of time. This shows the expected cash balance at the end of each month. To prepare a cash flow forecast, we should identify all cash inflows and outflows. Secondly, we should classify cash inflows as receipts and cash outflows as payments. And finally, we should draw a format and classify the different items under appropriate headings to calculate the net cash flow. We will look at how to prepare a cash flow forecast for only 1 month first. So for the month of March, we have as cash inflows or receipts, balance at start 5,000 rupees plus cash sales 75,000 rupees plus money received from bank 40,000 rupees plus government assistance 50,000 rupees, which gives us a total receipts or total cash inflows of 170,000 rupees. Now let's look at the cash outflows or payments. Purchases of raw materials 35,000 rupees plus wages and salaries 40,000 rupees plus electricity bills 5,000 rupees, which makes a total payments or total cash outflows of 80,000 rupees. How to obtain the net cash flow now? Net cash flow is the total receipts 170,000 rupees minus total payments 80,000 rupees, which gives us a net cash flow of 90,000 rupees. Now we will look at how to prepare a cash flow forecast for several months. For example, for the month of March, April, and May. For the month of March, we are going to use the same values. Balance at start 5,000 rupees plus cash sales 75,000 rupees plus money received from bank 40,000 rupees plus government assistance 50,000 rupees, which gives us a total receipts of 170,000 rupees. For the payments now, purchases of raw material 35,000 rupees plus wages and salaries 40,000 rupees plus electricity bills 5,000 rupees, which gives us a total payments of 80,000 rupees. The net cash flow will be the total receipts 170,000 rupees minus total payments 80,000 rupees, which gives us a net cash flow of 90,000 rupees. Now, at the beginning of March, the business had a cash balance of 5,000 rupees, and at the end of March, it had a cash balance of 90,000 rupees, which it is going to carry forward to the month of April. Therefore, balance at start for April will be 90,000 rupees plus cash sales 70,000 rupees. No money is received from bank and no government assistance is received. Therefore, the total receipts for the month of April will be 160,000 rupees. For the payments now, purchases of raw materials 50,000 rupees plus wages and salaries 45,000 rupees plus electricity bills 5,000 rupees, which gives a total payments of 100,000 rupees. To calculate the net cash flow, it will be total receipts 160,000 rupees minus 100,000 rupees, which gives a net cash flow of 60,000 rupees. Again, in the month of April, the balance at the beginning of April is 90,000 rupees, and at the end of April it is 60,000 rupees. This 60,000 rupees we will carry it forward to the month of May. Therefore, at the beginning of May, the cash balance will be 60,000 rupees plus cash sales 80,000 rupees. No money is received from bank and no government assistance is received. Therefore, the total receipts will be 140,000 rupees. For the payments, purchases of raw materials will be 40,000 rupees plus wages and salaries 45,000 rupees plus electricity bills 5,000 rupees, which gives a total payment of 90,000 rupees. The net cash flow will be the total receipts 140,000 rupees minus the total payments 90,000 rupees. We will obtain a net cash flow of 50,000 rupees. If you want further resources, you can click on these links. We hope that you have enjoyed this video. Until the next, it's goodbye from us.